Turning to a story that we have been following, GameStop shares have fell on Friday after the company fired its chief financial officer and announced plans to make job cuts. The layoffs come after the video game retailer hired more than 600 corporate employees in 2001 in the first half of 2022 in the wake of the pandemic meme stock craze. Here to discuss is Thomas Hayes, chairman of Great Hill Capital. Thomas, first, what do we know about why the CFO was ousted from GameStop after a pretty short tenure? I mean, he came right at the same time the CEO Furlong came. Is this a matter of the two not having a similar vision moving forward?
Yeah, well, this is not a good look, Alicia, to see the CFO who came in with the turnaround plan being fired or leaving the company. There's always two sides to every story. It really doesn't bode well. Plus, they overhired last year with the turnaround plan. Now they have to cut back. I got to say, Alicia, this really smells like Radio Shack and Blockbuster in the 1990s. Every strip mall you went to, there was a Radio Shack and a Blockbuster, and everyone said, Radio Shack will survive. There's no one else doing it. They're the last one standing. And I think as the digitization of games accelerates, the demand to swap out physical cartridges and to buy consoles is going with it. And I'm not sure that an NFT marketplace or blockchain or any other buzzword they throw out there to try to buttress the stock is really going to make a difference.
On one hand, I kind of agree with you, right? I mean, it does sound Radio Shack-esque, does sound Blockbuster-esque. But then I look at the stock, $127 a share. I mean, I'm looking pre-pandemic at $18 a share. It's still up pretty nice. And as I've said over and over on this show before, we've seen retail traders act as a bit of a hedge fund for this company to give them the opportunity to have the turnaround story despite kind of the recent news now. Is there really, truly the chance for this not to be Radio Shack-esque and GameStop-esque and this to be a part of the turnaround story to get a little bit leaner with some of the layoffs and truly maybe get a CFO that's in line with the vision that Furlong has?
Well, let's just do the math. I mean, they lost $141 million last quarter. They've got $1 billion of cash left on the balance sheet. So at the current burn rate, they can last for about 2 years. So if they can figure out some Hail Mary to turn around the company in 2 years, as they said in Dumb and Dumber, so you're saying there's a chance. And there certainly may be. Look, you don't want to bet against Ryan Cohen. I mean, in fairness, the GameStop stock is down 63% since its stimmy check highs in January of 2021. Chewy is also down 63% off over that period. That's the company he founded. So, there's a lot to do here. The NFT marketplace, you've got both Ethereum has collapsed and volumes for NFTs have collapsed in recent months. So that part of the turnaround plan is a non-starter at the moment. Unless they've got something else up their sleeve, every time they're asked about what their new strategy is going forward, they say, quote, "We don't want to tell you because we don't want someone else to steal our strategy." So either they don't have a strategy or they've got a great strategy, but the clock is ticking because they're running out of cash.
Your analogies this morning are on point from the Dumber and Dumber quote. and then the reality of the context of what you're saying there, on one hand, they could be very valid in saying, hey, we don't want somebody to steal our strategy, or they may not have one and they don't want to disclose that to investors directly. For investors directly, obviously, to your point there, GameStop down pretty noticeably off of its highs when those stimulus checks were out and about and people were just throwing money into this company, most of that being retail traders. Should investors truly be spooked right now? Because it's not the only stock out there pretty low. You look at the whole tech sector, and I could name a handful of companies that are off, pretty similar numbers here. Or is this, in fact, something they should be spooked about and really should think about pulling out of the company?
Well, look, interestingly enough, there are many high-quality tech companies that are generating cash that are down big numbers just because the market's down this year. And that's where I'd be looking to put my cash personally. As far as hoping for a short-term short squeeze because 21% of the float is short, or thinking a 4-for-1 split is going to attract more retail dollars and hopefully the stock price goes up. At the end of the day, it's the same size pizza pie. They're just adding more slices. So the stock is not getting quote unquote cheaper, even though the price is. So, the issue that we have here, Alicia, we've seen it in Bitcoin. We've seen it in a lot of assets that were very speculative, is that once capital has a cost, as interest rates have gone up, the speculative froth has come out of the market, and investors now demand that businesses are cash generative. So something like this, a Hail Mary and a dream may work out, but the odds are not very high. So maybe you have a little bit if you like to gamble on, the jockey in this case with Ryan Cohen. But, short term, the stock can do anything. But if you look down the road with the amount of cash that they have and the amount of burn that they have, the prospects are not great unless they pull a rabbit out of the hat.
Let's talk about that stock split, 4-to-1 stock split. What do you think is the thought process behind that? Obviously, with the stock split, we know it fundamentally doesn't change anything about a company, right? It's like taking one slice of pizza and cutting it, in this case, into 4 different pieces. But oftentimes, we do get a bit of a bump, and to some, investors, it changes the mindset. Do you think that's what GameStop was going after, or something else is at play here in terms of, the opportunity to split the stock at 4-to-1?
Yeah, this is a last-ditch attempt to attract retail capital, whatever's left and wasn't blown out in Bitcoin and other meme stocks. Institutions are avoiding this stock like the plague. So by doing a 4-for-1 split, they're hoping that at a lower stock price, millions of retail investors can afford a few shares and maybe buttress the stock until they announce or execute on an actual turnaround plan, which so far has been fleeting and unfounded. So this is just one more attempt to kind of keep it going. And I got to say, in Ryan Cohen's shoes and in the CEO's shoes, you do try to keep everything going. You want to keep the jobs going. You want to keep the cash flow going until you can potentially turn it around. But right now, the outlook is pretty bleak on this one.
The outlook is pretty bleak. I know you just said a moment ago, institutional investors resisting or avoiding the stock like the plague. Do you think there is any credence to GameStop's, while they haven't outlined a full strategy, they've left breadcrumbs out there, right? The idea of getting into the NFT space, doing more e-commerce, kind of obviously with Chewy and Ryan Cohen, there's a lot of interest and excitement in maybe being able to do that. Do you think there are possible paths forward for this company or a company just like GameStop? Or is this truly a blockbuster? Is this like we're not renting DVDs anymore? We're not utilizing, hardware, gaming systems and walking into stores and then buying something like that?
I think the one area that maybe they would have a shot is becoming like the Amazon or Netflix of gaming, where they could have a subscription-based online rental platform where people could pay 10 or 20 bucks a month and play as many games as they want. The problem is they're competing against cash-rich companies like Netflix, who are already moving into that space and have a lot more runway and can absorb a lot more losses until it gets traction and you have takeoff. So maybe they can pull something special off, but for my money, there are better places to go where with stocks down 50% that actually generate cash and have a clear future versus a hopeful future.
Got it. I was just trying to play the devil's advocate, and it is a hard, devil's advocate story to kind of play on the other side. As I was kind of alluding to before, GameStop isn't the only company that's dealing with these wave of kind of recent layoffs. And even with the pressure on its stock, right? We've seen a lot of other companies starting to talk about layoffs, especially within the tech sector. What do you make of this broader uptick in this trend?
Yeah, well, look, the Fed has little control over much of inflation in terms of they can't produce more oil, they can't change energy policy, they can't stop the war in Russia and Ukraine. So all they could do to solve the problem was destroy demand. And they've done this by pretty aggressive rate hikes and certainly very aggressive jawboning to bring down demand. And they've actually done that. So companies are responding. They're saying, we understand what you're trying to do in terms of destroying demand. We want to be positioned for it if and when we see the slowdown in our businesses. We want to still be able to generate cash, and we don't want that excess cost. So, you're at 3.6% unemployment. We saw a very strong jobs report on Friday. Even if we ticked up to 4% or even 4.5%, that's still better than the long-term average. And I think the economy could withstand that. And I think companies are just trying to get ahead of the curve on that.
Yeah, when I see a headline like that or see all these layoffs, I think there's two ways to read it, right? There's one way of like trouble's ahead and this company is worried, or the other way is protecting margins and really positioning itself to kind of withstand maybe some tough and turbulent times. And it seems like the latter is what you're talking about a bit more here. Thomas, always appreciate your time and your insight and all your great kind of analogies in this segment. Thomas Hayes, chairman of Great Hill Capital.